Welcome to America's Heroes Group.
And welcome back to America's Heroes Group. In this segment, we have a roundtable with community outreach. May is Mental Health Awareness and Military Caregiver Month. Our host is Kelley. I'm the co-host, Claiborne. Our executive producer is Glenda Smith. And our digital media producer is Ivan Ortega of Scouts Honor Productions. And we have our panelist on the line today. That is Lisa Gavin. She's the CBI Vice President of We Build Your Credit. And we're going to talk about what is the credit repairs needed for financing mortgages, refinancing mortgages, being a first-time homeowner. What do you need to do in this area here? Lisa, can you hear us?
I can. How are you today?
Pretty good. How you doing?
Doing great. Thanks for having me.
And if I forget to do this, happy Mother's Day tomorrow. If you're a mother.
Thank you so much. I am.
I appreciate that. So then now tell us what we need to know about credit repairs and also what's going on with financing mortgages.
Well, the climate is interesting right now, to say the least, when it comes to buying property. Property purchases right now are extremely competitive. Mm-hmm. We see an environment where not only do you absolutely have to make sure you qualify, which we're going to get to in a second, but you're also facing a market where people are overbidding for properties to get them. So it's just a really tough market out there. So the bottom line is, even if it is not per se the best time to buy, you have to always be preparing yourself to buy. And so we're going to get to the specifics of how you do some of that today.
That's right.
Yes.
So how do you prepare yourself to get into, actually, first of all, let's first get clear. There's different ranges of credit. So you have people that have bad credit, people that have no credit, people that have good credit, but yet still are not credit worthy for particular purchases. Can you speak to that a little bit and how that works?
Sure. Well, let's start out with those with no credit. Obviously, you have no chance to purchase a property if you have no credit, because credit is an indication of whether you can be trusted or not. A mortgage item is a pretty big ticket item. And so you have to understand that they have to trust that you can manage it. If they don't see anything on your credit report that demonstrates an ability to be trusted and to manage debt, then you're not going to be able to purchase property. So let's start with those individuals. The bottom line is that you have to start doing things to build credit. Your debit card doesn't do it. Money that just is sitting in your bank account doesn't do it. You have to apply for some pieces of credit that build you. And so one of the things that I recommend people do is to get a secured credit card. And that just simply means that you pick a company that you put money in the bank as low as $250 to $300, and then they issue you a credit card. It's called secured because they're holding on to that money in case you're a bad boy or a bad girl, and that you're not managing that credit card. But it's a much cheaper way to start than to get these horrible credit cards that charge you ridiculous fees to even get the credit card. Bad annual fees, bad interest rates, application fees. So it's much better to get a secured credit card. The other option is there are CD savings programs. Self-Lender is one of the ones that I refer people to. You can go there and do a savings plan where you save money and they automatically take it out your bank account, but it reports to all three bureaus. So essentially you're getting positive reporting just for saving money. So that's something that people with no credit or with challenged credit can do to start building some positives in the midst of whatever, repair issues they may have.
Now, are you seeing more banks get involved with this and offer these types of programs?
Well, there is always an industry that emerges for that clientele. A lot of times your traditional banks you think of, Chase, Citibank, they tend not to get involved in a lot of that stuff because that's not their clientele, to be honest. They're some of the biggest banks in the world, and they hold a lot of money, and they want people with money. So when you're challenged or starting out, those are not your best options. You really have to move to the market that exists to help people with challenged credit or no credit.
Now that leads me to my next topic, which is technology. Technology is something that we talked about in our last segment. And also, by the way, on our Facebook page, you can leave. I'm going to leave some comments and some information about what we're talking about, so you can click on those links and hopefully get some more information. We'll also do the same thing with what your topic is about. But the thing of it is that we talk about technology. It seems like it's leveled the playing field and changed the way that we do business and also how we think about money. I mean, 10 years, 15 years ago, we never would have thought of anything called cryptocurrency. But then now that technology that made cryptocurrencies now become blockchain technology, and that's what's leading the future as far as banking and how transactions are done and how records are kept with finances. Now, speak to this, people that have bad credit, who have made mistakes. First, I would say, though, before we go into that, first thing I would ask is, what are some of the, how do people get into bad credit to begin with? What are the most common mistakes that people make that messes up their credit?
Well, this should make everyone feel better. Life. We all have challenges in life, divorces and loss of jobs and income and things like that. So that's the obvious, right? That life happens. And so there's always going to be somebody that needs to improve their credit. So don't feel bad because that's the situation. But some of the mistakes that people make that are within their hands to manage is understanding that you need to manage your credit. So if you're in the process of looking at buying a home or buying anything for that matter, you absolutely cannot be late on anything because your credit is your anchor. So excluding the situations, of course, where people just simply can't, right, because they don't have the financial means, make sure your minimum payments are paid on time. You can be late, but you cannot be 30 days late. That can literally crash your score 50 to 100 points. Easy. And then whatever purchase, home, or anything is automatically out of reach. So that's probably the number one thing that I notice people do wrong. They just kind of give up and say, hey, there's too much going on. And they either forget or they, just kind of say, I can't do it. But here's the truth of the matter. You mentioned technology. Here's where technology comes in handy. Put a calendar reminder in your phone for when that payment is due. Technology is in your hand every day on your cell phone. So you can use that. And I advise my clients to do this all the time. Put a reminder in so you won't forget. But when you have major things you're trying to do, you cannot afford to forget, period.
And also you touched on something very important, Lisa, that people oftentimes think, and I hear this all the time, where someone makes a payment one day late, and they think they've ruined their credit or crashed their credit. It takes 30 days before it's reportable. So even if you miss the deadline on the bill, you have, it's that 30th day is where the deadline is. So don't say, oh, I missed it, so it's too late now, I'm just going to let it slide. No, you actually have 30 days from that deadline to get that payment in. So don't mess up your credit. Make the payment as early as possible. Don't go past that 30th day. And then again,
very, very important point. Thank you for bringing that out. Because a lot of times people don't distinguish between being late and being 30 days late. So the company may charge you a late fee because you were late, but they're not going to report it to the credit bureaus yet because you're not 30 days late. So that is that window of those additional 29 days you have, get that payment in.
So a person is in that middle process. How long does it take a person to get credit worthy? Say they have bad credit and they've gone through the process of trying to rebuild their credit. What's the normal time for them to get credit worthy enough to basically get a mortgage for a home?
I'm going to be honest with you. On average, it takes a person a year a lot of times to get in position because there's things that they have to initiate. They a lot of times have to do some type of or some degree of repair maybe. But they also need to start building some positive credit, and then that positive credit needs to be reporting over a period of time. And most of the time when you get new credit, it takes about 6 months of on-time reporting before lenders are confident that, okay, they have the hang of this now. They seem to be managing this well. And after it hits 6 months, it's building into your scores much more than when that obligation is brand new. So given that type of time frame, it usually always takes months. And in most cases, it takes people about a year. So you really want to give yourself enough lead time to work on your credit and make sure things are in order before you're moving towards a major purchase.
So before we get to that last score we talked about, which are people that have good credit, seem like on paper they actually have everything that they need, or at least in their mind they think so, but yet still have a hard time getting approved for a mortgage. Before we get to that question, what in that middle group that's rebuilding their credit, what are the critical things that creditors are looking for to give you a mortgage on your credit report or on your credit history?
Well, a lot of times people have what I call a bad credit mix. They don't have anything in the installment loan category. Installment loans are car notes, student loans, things that you pay the same amount every month and demonstrate that you can pay those installments on time. Even the CD savings program I mentioned is an installment loan. Sometimes people don't have that type of history, which can make a lender, a potential mortgage lender, wonder if you are able to handle that type of consistency. But I've absolutely seen people who only had credit cards that they've managed on time still get qualified for a mortgage. So, it is good to work on having a good mix of credit. More important to have enough open and active credit to drive your scores up. Meaning that if you only have one or two open accounts, a lot of times it's not going to grow your credit scores fast enough. So, unfortunately, it may mean you have to get more credit, and some people are afraid of that. But if you want your scores to increase faster, you need more items reporting open, active, and saying that you manage your obligations in order for your scores to move up faster.
Okay, so that kind of brings us into that middle category again, because we talked about people that are trying to start from scratch, and the rule of thumb I always worked with was if you want to have at least 5 lines of credit open for at least 3 years with no late payments, and that puts you in, at least you should have good credit after that. Now, where your range falls, we can go into the criteria. That's for a longer conversation, like what other factors separate the 700 score from an 800 score. But that's basically what gets you. You should be able to be credit worthy if you have at least 5 lines of credit with no late payments for 3 years. Now,
and actually, I'll say 2 years.
Okay,
2 years is the weight that's put by the scoring system on most people. 2 years is that window that if you've done everything well for 2 years, usually you're pretty good.
Okay, so then people start getting more credit, and then they start getting those temptations. They have the birthday that comes up, the Christmas that comes up, or they're trying to pay a gas bill or a water bill or whatever, or So how do you manage that temptation so that you don't get into a situation where you're overextended on credit?
Right. Well, it's very hard when it's not with you, meaning Mr. Credit Card. So, we can shop from home these days. But the truth of the matter is you need the credit. So it's a necessary evil, if you will, right? I simply do not carry those cards with me. So if I work to pay something down to 0 and I want to leave it at 0 for a few months, it's not in my wallet and it's in a drawer somewhere. And so that means that's for emergencies. It doesn't get pulled out unless there is an emergency. And it takes away that impulsiveness that a lot of us have, because it's not with you. So it's a little easier for you to not just let your impulse to take over. And so keep in mind, and I tell people this all the time, the credit cards aren't the bad guys. We are. So you just have to prioritize what you really want to do in life. Is that purse more important than you qualifying to get your house? It's a lot of times it's very simple decisions, but the main thing is just don't take it with you.
Now, in your business, do you counsel people with building credit? Is that correct?
I absolutely do. Yes.
So when you go on that journey, what are some of the things that you tell, besides what you mentioned before, but what are some of the things you tell people to help them stay on track? So because you can leave the credit cards at home, you can do certain things, like you mentioned before, life happens, things, do you recommend sometimes maybe changing your lifestyle or changing what's in the environment? Because I always believed that if you change the environment, this is an old military idea, your environment, if you can control the environment, then you're a better chance of having success. So, but if you're not in an environment where you have maybe changing where you live, maybe getting a cheaper apartment, maybe going for a cheaper car, those types of things. What is that conversation like when you're trying to help someone in that middle category where they've had gotten credit, but then maybe did some things that maybe brought down their score or brought down their credit? How do we get to that? How do we change our behavior so that we get better credit?
Sure. The way I think about it is a lot of people can't per se change their physical environment immediately, but you can change your mental environment. You can get away from folks that do a lot of spending. They go out and you're doing a lot of drinking with that person. I think you need to hang out with that person a little less, or changing your mental environment. A lot of times for me working with clients is let me give you the vision. So from where you are to get there, you're going to have to do this, and stop doing that. So you can, on your own, determine what are the things I need to change. What are some of my bad habits that's costing me? I have a friend that does everything on auto pay out of her bank account, but yet she bounces checks and gets late payment fees all the time. Well, maybe auto pay is not for you because obviously you don't have enough money in there every month to cover the expenses you have coming out auto. And then so she said to me, well, but I might forget. Use the option in your phone that gives you a reminder. Put in your calendar to remember to pay. But save yourself the money from your bad habit. So a lot of times it's just thinking through what things just keep causing me the same headache. What people do I need to get away from that's facilitating bad habits? But if you have the vision of what you want to accomplish, and a lot of times for me helping my clients see what those steps are, once they see the vision at the end, it gets a lot easier to make the change. Because you're like, nothing's going to get in the way of me getting this house.
Wow.
So that's what's important to me is change your mental environment.
I think we could do a whole 30-minute segment just on what we're talking about right now. Changing your mental environment. I mean, because, we definitely have to come back to that because that's something really important. I mean, just my 2 cents into that category, that it's about managing cash flow. But the problem is that most people they don't think in numbers. They think in what they think differently. Some people just cannot see numbers. Some people are gifted to see numbers. Some people are just thinking a different way. And those people tend to have a hard time with budgets. And this is true. So that tends to be the case. But for that last category, let's talk about those people that have good credit, at least in the numbers. They pull up their credit karma or whatever, and they have a 700 credit score. But they go to the bank and they're finding out that they're getting denied for the things that they want to purchase. They want to get this, car or this boat, or they want to get this house or refinance. And they're not getting the rate that they want. They're being told that they're not in that right tier. What's going on there?
Typically what's going on is that they may have a bad credit mix. We talked about that. They may have too many credit cards. They may have too many credit cards that are still carrying debts. Or if you owe a balance on every single credit card you have, that makes lenders nervous, even though your scores may be good. So sometimes it's just simple restructuring of how they're doing things. So some of the things that I advise to people is just not have balances on every single credit card. Even if your usage is decent, meaning you're under 50%, but just the sheer fact that everything has a balance is not good going into lenders. Sometimes it's a situation that you've already accumulated too much new credit over a short period of time, and you need to let it cool off. So that means you may have to go 6 months not applying for anything, a year not applying for anything, to allow your credit to kind of regenerate, because those inquiries count against you. And lenders get nervous. Sometimes they'll deny you just because you've applied for too many things recently. It's not because your scores are bad. So there's different reasons that lenders look at you in different ways. So sometimes just slowing down and cooling off. Sometimes it's just focusing on paying down a few things so that everything is not reflecting balances. Sometimes your credit just needs to age. And because some lenders, to be honest with you, like more sophisticated clients. You look a little more established. You can't get there until time does that. So sometimes it's not a quick and fast answer, I hate to say.
Now, we're talking about buying mortgages. So, and we mentioned earlier, but not to confuse people, but we already established and agree that when you put money into a savings account, or if you get a certain bank account, that does not improve your credit. However, when you're applying for a mortgage, what role does your cash flow and your finances play in that homeowner's application for the mortgage?
Sure. Well, everything they're looking at is DTI, debt to income ratio, and that does not solely rest on your credit scores. And so that's where the numbers really come in, because the bank is trying to figure out, hey, okay, you have these many debts on your credit report. I see those. And then you're also telling me you have these other obligations that you're paying. I need to make sure you're going to have enough money to afford this mortgage. And so debt to income is a really big deal. And a lot of times people are, for instance, looking, I want to buy a car, but I want a house. Your best bet is don't get that car before you get that house, because then now that monthly payment on that car is going to tighten your debt to income ratio, because they're going to be concerned that you have too much debt to afford the property. one way that I think is really interesting for people to think about that helps that is buying a 2-flat. A lot of people are just so stuck on the dream home, but when you buy a 2-flat, that means you can live in one unit and you have a unit of income. And so the next floor becomes income, and it's easier to afford a 2-flat than a single family. Why? Because you'll have revenue coming in, and it'll reflect additional income. And then when you get ready to buy your house, you'll have more income now, because when you move out of that 2-flat, now you'll have 2 units generating income. So a lot of times we just have to open our minds to what we think the next move should be. If your debt to income is tight, then hey, buying a 2-flat actually helps, because they count that second unit as going towards income for you.
So to kind of reiterate, so when we're talking about debt to income ratios and debt to income, what people need to understand is that when you buy something or you have an obligation to pay something, they're looking at all the stuff that they can find on you that's going out the door as far as money coming in. You get your paycheck on Friday. So on Saturday, Sunday, Monday through next Friday, what are you paying bills on? What is coming off that paycheck? If we add on a mortgage to that, if you're bringing in $1,000 a month, but you're paying out $700 in debts and income and obligations every month, you can't afford another $500 mortgage.
Exactly. And so that's really just as big, because even if you have low credit scores, there's still mortgages that you can get into with low credit scores. I mean, I've seen people, they come out with mortgage products that approve you somewhere between 6 to 650, and you can still get approved for that mortgage. But does it mean your interest rates are going to be higher? Of course. So you can fudge credit scores a little bit. Debt to income, you can't fudge. Either they see that you have enough income versus the debts that they're seeing for you to afford it. Either you can or you can't. The only other thing you can do is buy that property jointly with someone, because now their income factors in. But guess what? Their credit has to qualify also. So, but debt to income is difficult to fudge.
So then now tell me this. So how do people connect with you? And also, what is your information, your website information, social media handles? Give us that so we can contact you and get help if we need it.
Sure. We have a website, webuildyourcredit.com. Okay. We can be webuildyourcredit.com. We can be reached at 312-971-1357.
And then now, another thing, back to the serious stuff. Now, this is something that's on a lot of people's mind right now, because the Fed just raised interest rates. And they did it twice this year. So,
yes.
And they're talking about doing it more and more and more. Are there certain, a little bit of time we have left, maybe about 5 minutes left, roughly, a little bit less than 5 minutes.
Sure.
Do you see ARMs, adjusted rate mortgages, coming back into play? Are people, are banks and mortgage companies starting to sell these more? Does that pose a danger to people if they try to go back to these mortgages like they did during the housing crisis?
Well, in my opinion, it absolutely is dangerous, because so many people that actually fueled the whole entire crisis, where people lost their homes. Because those mortgages, they put them in horrible mortgage products. And what happened? People couldn't afford those mortgages when the rates adjusted, when they did adjustable rate mortgages, meaning that it's low for 5 years. And after that, the rate skyrockets, and then people can't afford the mortgage anymore. So I absolutely fear those types of things coming back, because banks are greedy. And when it gets to the point that they feel like people can't qualify for mortgages in traditional ways, that's when they come with these creative programs. And I can't tell you that I'm confident that the government has done a good enough job making sure that stuff can't come back, because we've been in an environment where they've been deregulating. So, yeah, that's a scary thing. But all I can say is that you have to know what you can afford and stop living beyond your means, period. We have to be the ones to police ourselves, unfortunately.
Well, that's the thing that gets me concerned, is that a lot of the average person can't really differentiate what a 5-year or 5.5 arm, a 5.1 arm, a 27.1 arm, all these different crazy things that they come up with.
Yes.
Then they say, okay, well, this is going to get you. If you want to pay, the lender might be saying, okay, you can either pay $500 a month for this house, or you can pay $300 a month for this house. Which one looks better to you? And the person's going to say $300.
Right.
So then, what is their best defense to try to get either the information or get counseling or help to uncover what they should be doing or what they should be avoiding?
Well, the bottom line is you want to try to get into traditional products. Any type of specialty products, you just have to look at with a side eye. We all know what happened. If you were part of that crisis in 08, 09, where the market crashed and, I almost lost my business just trying to survive through that crash. It was horrible. So if you know that, don't walk back into these crazy products just because, I want this house at all costs. No, we shouldn't want anything at any cost. So, it's just, I might be preaching to the choir, but the bottom line is, there's nothing we can do about that. You just have to be really cautious about researching what you're getting into.
And I would add, if you have someone you can trust that is good with finances or a professional, find someone that's a professional that does this, maybe not trying to sell you a product, but someone that can give you counseling and maybe get some help,
And I'll say this real quick. That's the benefit of people working with folks like us, because my job is to help the consumer. I'm not the bank. I'm not trying to help the bank out. I'm trying to help you out. So, the whole thing is to make sure that you have people, consultants, professionals that understand the industry and are not just trying to sell you. So,
Lisa Gavin, CBA Vice President of We Build Your Credit. Appreciate your time and appreciate you coming on our show.
Thank you so much for having me again.
This is America's Heroes Group. We'll be right back.